Hi everybody, welcome back. My name is Sanj and today we're going to talk about ETFs. Now ETFs stand for Exchange Traded Funds, and these are a great way to get exposure to the Australian share market in a nice, diversified, broad, low-cost way. In this video we're going to talk about what ETFs are, some things to look for when trying to decide on an ETF, and I'm going to run through a few examples of ETFs that cover the Australian market. So what is an ETF? An ETF is an exchange-traded product that seeks to deliver the return of the relevant index by investing directly in either all of the securities or a representative sample of the securities included in the index or benchmark. Basically, where instead of investing in specific companies in the share market, which can be challenging because you have to do research, you have to understand what the company does, how it makes money, what the broader market is doing, how your company fits within the broader market. Instead of doing that, there's a slightly easier way of investing in the share market, which is where you'd say you'll invest in the top 200 companies because, broadly speaking, they'll do okay over time and that they're a good representation of the entire share market. So in the Australian Stock Exchange, there are over 200 ETFs to choose from, and you can get a broad list of these when you go to the Australian Stock Exchange website and look under ETPs, and I'll do a bit of a screen overlay. You look under ETPs, you look under listed ETFs, and on there you can see, for example, things like listed investment companies are there. You can see the actual ETFs, which are index funds. You can see active funds. You can see quite a broad range of funds all listed there with links directly to their product pages. And these are all things that you as a everyday retail investor, that's what normal people are, they are retail investors, can buy through your stockbroker. Now, when you're looking at an ETF, there are three key things to look at to understand what the ETF represents or what you're essentially buying. So the first thing is the investment objective. This will list out in broad terms what the ETF is trying to do, which index it's trying to track, which country it's trying to broadly track. The second thing is the index itself. So this is what is the index that the ETF is pegged to and it's trying to track and trying to replicate the returns of. This is important because it'll help you differentiate between two ETFs that may look like they're tracking the same thing, but when you go into the detail, it'll actually show you that this tracks the top 200 companies, whereas the other one tracks, say, the top 300 companies. And lastly, you should look at fees. What are the fees and how do those fees compare to the fees of other ETFs that are doing broadly the same thing? So we'll run through this as a bit of an example using 4 ETFs that cover the Australian stock market. These are the Vanguard Australian Shares Index ETF, the SPDR, which is also SPDR ASX 200 fund, the iShares Core ASX 200 ETF, and the BetaShares Australia ETF. So I've just put together a quick slide here where it's got the 4 funds that we just talked about and key parameters around each of these funds. So along the top, you've got the ASX codes. These are important to remember because this is what you'll be looking for when you go to your stockbroking website like CommSec or NAB Trade or ANZ E-Trade to go and buy these shares. And then you've got the names and then you've got the investment objectives. So I'll just read out the one for VAS to start with. This is Vanguard's Australian Shares Index ETF that seeks to track the return of the S&P ASX 300 index before taking into account fees, expenses and taxes. And then you look at the IOZ, STW, A200, they broadly say the same thing. Now, you start to see a bit of differentiation when you look at what are the index that they're actually tracking. So for example, VAS tracks the S&P ASX 300, which is the top 300 companies in the Australian Stock Exchange. Whereas you've got these two over here, the SPDR and the iShares, which track the ASX 200. So again, you can see one of the companies tracks 300 companies, the other two track 200 companies. And then you've got BetaShares, which says it's also tracking 200 companies and it's an investment objective, but it's using a different index to do this. Now, I'll leave a little link in the description below where one of the representatives from Selective took part in an interview where they describe how their Selective Australia 200 index is different from the S&P ASX 200 index. So in the last row, you've got the fees. Now, this is the most interesting part for a lot of people. And you can see there's a bit of variety, even though essentially these indexes are meant to be doing the same thing, which is broadly tracking the Australian Stock Exchange. So you've got VAS, which is kind of your Vanguard large index fund, 0.1%. Kind of normal for where an index fund fee should be. Then you've got this interesting thing going on here where you've got iShares and SPDR tracking essentially the same index with a different fees. So this is kind of interesting, and obviously I'm not giving financial advice, but I would certainly be wondering, why is there a difference in fees for these two funds even though they're essentially tracking the same index? And then lastly, in terms of fees, you have BetaShares, which is sitting at 0.07%, which is essentially the lowest for indexes that are tracking the Australian share market. Now, I think there's probably a few things you can read into here. The BetaShares product is quite new, and I get the feeling that they're trying to take a position in the market and they're aggressively pricing themselves to try and take up quite a bit of the share in terms of ETFs tracking Australia. The other thing is that they have a different index that they're tracking, still broadly the same thing, top 200 companies, but they're tracking it. They're using a different index, and maybe there's something around the fees that they have to pay to track an index themselves. I'm not sure, but certainly worth considering is, why are the indexes different, and does that impact the fees that they're both charging? A quick side note in terms of fees: when we're talking about fees, these fees are essentially removed from the distributions or the returns you get from the ETFs. So it's not like these guys are going to send you a bill once or twice a year saying, hey, pay your fees. The fees will be taken out before they give you your distributions. So there you go, guys. That's an example of 4 ETFs that you can purchase right now through your stockbroker, and you would get direct exposure to the Australian Stock Exchange, where you'd essentially be buying this ETF, which in itself holds companies such as the top 200 companies or the top 300 companies. Now, when I look at this from a broad point of view, I can see straight away that the key thing is, for VAS, it seems to have the broader selection. So there's top 300 companies, so you're a little bit more diversified than, say, picking the top 200 companies. However, over time, there could be the case to be said that the ASX 200, because it's only the top 200 companies, may perform better over time. But that's up to you to have a look at, to consider, to speak to your financial advisor about, saying, what's the difference between getting the 200 versus the 300? And would there really be a difference between using BetaShares, which uses a different index, than looking at the other 3, which essentially track S&P's indexes? So a few things to keep in mind, and this is the key thing, and this is the purpose of the video, is to get you guys interested in ETFs, or get you guys understanding about ETFs, but also to get you thinking about what are the different things that I should be considering when looking at ETFs to purchase. Because remember, we've just talked about 4 ETFs on the Australian Stock Exchange. There are over 200, and they do broad things, like some of them will track specific markets overseas, some of them will track specific industries. I know BetaShares themselves have an ETF for so many different things, like lithium battery providers, robotics companies, mining companies. They've got an index for everything. And it's up to you whether you want to use that index to get exposure to that particular industry or particular sector. Now, it'd be wrong of me not to mention a few risks associated with investing in ETFs. So first of all, these ETFs essentially mean you're now invested indirectly in the top 200 companies. So if anything happens to any one of these companies, they have a bad quarter, they have a bad half year, something happens to these companies, their value goes down. And if they're within the index, that means the index's value will in some way go down. If it's obviously a small company within the index, it will have a less of an impact if it's a large company in the index. If you have things like large global events that impact the share market as a whole, that can cause the index to go down as well. So these are all risks that you need to consider, which generally are the same across the share market as a whole. There's some specific risks to ETFs are, if you buy an ETF that is trading internationally and it's not currency hedged, then the value of that ETF can go up and down, not necessarily because of the index going up and down, so those companies overseas have gone up and down. Your ETF can go up and down purely because the currency of Australia, or the currency that the country is operating in, has fluctuated. So that's something to keep in mind, and you can manage that by buying currency hedged ETFs. The other thing to keep in mind is liquidity risk, which is essentially where an ETF that's broadly being purchased or quite popular, quite heavily traded, wouldn't have as much of a liquidity issue as, say, an ETF that is quite specific, quite a niche area, and you may not have as many people trying to buy and sell that ETF, and therefore when you want to get into or get out of that ETF, it might be challenging for you to find an ideal price that you want to get in or out of. For example, you might have to pay more than you wanted to, or you might get less than you wanted to when you tried to sell that ETF. So it's just a few things to keep in mind. If you are interested in learning more about ETFs, there are many resources out there that you can access. For example, the ASX has done a small online course for free that you can go and look at, which covers ETFs and other exchange-traded products. The Australian government has the Money Smart website, which has a bit more information about ETFs and what to look for and what to be wary of, and Investopedia, and then other YouTube tutorials which broadly cover ETFs. So there you go, guys. If you enjoyed the video, make sure you hit the like button. And hey, if you want to share some other ETFs, or you have other questions about ETFs, or I'm curious to hear what ETFs do you have in your portfolio, make sure you comment below and subscribe for future content. Bye for now.